So welcome everybody for joining us this morning for the webinar on some of the lending opportunities in the current interest rate environment. I'm pleased to have Brett with us today. Brett's our resident expert on all things lending, helps many of our clients with their considerations around the finance that they have, be it business or personal. Obviously, with the way interest rates are going, there's plenty of pain out there compared to where rates had been. But as Brett will explain a bit later on, there are also plenty of opportunities for people at the moment to take advantage of, certainly in the current climate that may not be there forever. So welcome, Brett, and thanks for helping out. And for those that don't know, Brett and I work closely together with all our client considerations when it comes to these things. And the beauty of that is that we bring our structuring and financial tax advice to the table, and Brett really adds value on the finance side when it comes to structuring of finance and the rates applied, et cetera, et cetera. So thanks, Brett. I'll over to you.
Thank you, Ty. Yeah, and good morning, everyone. Thanks for joining us. So just a little bit about myself first before we get going. So I'm a mortgage broker, so not an accountant. Work exclusively within Wilson Pateras. So I joined the team about 18 months ago after 12 years in a bank, in various banking roles here and there. Basically, it started chatting to the gentlemen that run the firm here. They'd identified that a lot of clients want to have conversations about lending or working towards getting finance for whatever reason it may be, either personal or business, but not necessarily want to engage a bank immediately. Don't know maybe what information they need to take to a bank, or if they're going to bring something to the table that either helps or hinders, and just being able to wanting, able to engage an expert before you get to that bank conversation. Not only that, but also not knowing, if one bank tells you one thing, how do you sanity check that? Do you take that to 5 different banks and have the same conversation elsewhere? How do you find the time for it? How do you find the people for that? So, as I said, I was with the big banks at that time and came and joined the team here to provide exactly that service for our clients. So, I welcome, as we go through this webinar, I'm going to talk about the things I think that most people have on their mind at the moment, mostly interest rates. A big one at the moment is fixed interest rates maturing, but please feel free to jump in with any questions. And Ty, if I can please ask you to monitor those, and feel free to politely interrupt me whenever you see fit.
Absolutely, we won't talk football. Go for it.
Yeah, sure. So firstly, an important disclaimer there. This is general information only, so it's not advice. It's not personal advice for anyone. I haven't taken anyone's personal circumstances into account here. So please, if anything does seem like it might be relevant, engage us separately afterwards. Thank you. So some of the main topics that we'll go over there. What to expect if fixed rates come up. So there's a huge number of fixed rates maturing from about now until June, July this year, which is when the fixed rates kind of stopped reducing. So there's a lot of clients we've got that are going to go from maybe even, I say sub 2.5%. There's going to be a lot that are even on sub 1%, sub 2% that are going to go to over 5%. So we'll talk about the implications there, what to expect, and the process, what can be done about it, if we do have such an increase like that, that's going to make things really tough. Can things help in any way? So firstly, just the process with the fixed rate maturing. So if anyone hasn't gone through it all already, basically the bank is just going to revert your loan to a variable rate. They'll tell you a month in advance. They'll send you a letter through the mail for those that do still check our mail. Probably a pretty easy one to miss. They'll send a letter. It's going to quote a rate in there. The rate's going to be probably 6 weeks before the change actually happens. Who knows if that rate's still going to be accurate. The rate, depending on what kind of loan you've got, generally what happens is the banks have a standard variable rate, which they benchmark all their other products off. Then below that, they'll have a discount for maybe a loan package or something like that. And then they'll have the rate that they're going to give their new clients. You're going to go here. So they're going to give you the package discounts that come with the type of loan that you've got, but they're not going to give you anything lower than that. The degree to which that difference, how pronounced that difference is going to be different for every bank. We're actually chatting to a gentleman at the moment. So I've got the numbers here. So his fixed rate matured. he went to a rate, this is with a big four bank, just a normal loan, nothing overly unique. 6.82% they kindly put him on, almost 7%. He had a conversation with the bank, and it was dropped just purely on the back of that conversation. It was dropped down to 5.49%. So from 6.82 to 5.49 is the kind of difference that you're looking at for that, this is the rate that you're getting versus this is what you can get if you ask the question. Huge difference. And that 5.49 is commensurate with what they would be giving people that called up for a new loan without having to bargain. Just call up and ask for a loan. That's what you're getting.
That's a significant return on investment right there, just for the sake of a phone call.
Not a bad phone call, is it? Over 30 years. Yeah, work that out. Further to that, though, so we had a little conversation. So we were chatting in the background anyway, but when he told me that rate, I prepared a little email for him just showing some of the other rates available out there, and the rate that he ended up with was 5.39. So another,
very good.
So 10 or 15 points off. The other thing we can do as well, so separate to that, so you're going to roll over basically just onto a variable rate. The option does exist as well to refix. Probably the first question I get is probably what happens. The second question is, should I refix or not? Again, I'm not an economist, so I can only speak to what the economists say that I personally pay attention to. And things have just changed. It's a really interesting time with fixed rates at the moment, because we had a situation where we had RBA increases in line with economists' expectations. And that was for, say, 2 or 3 interest rate increases this year, balancing out to the end of the year, end of the calendar year, and then coming back down in 2024 by, say, 1.5 to 1.75%, bit of a variance depending who you listen to. So we're 2 down with an expectation of 1 more, which just recently has started to change because of everything that's going on with banks overseas. And now there's a lot of uncertainty around that. It might be that we're flat now. We might even be looking at interest rate decreases this year. We just don't know. And what that means is the banks can't really price in an accurate reflection of that to their fixed rates. So on Wednesday this week, you would have called up Macquarie for a fixed rate at 5.8%. Now today you do it, it's 5.5%, but that's still not really in line with the expectations of what the economy is going to do over the coming 2 years. So now to compare that to the variable rate, Macquarie might have you on, say, 5.25 to 5.3%. So say about 1/4% below what that new 2-year fixed rate is. But that's today. If we don't have any more increases and we only have decreases, well, today you're 1/4% out of the difference on that money. But in 2 years' time, when that fixed rate matures, you're going to be a lot further away from it. So it's really hard time to predict that kind of thing at the moment. And I would suggest that almost daily, banks are going to be updating their fixed rates probably for the next month.
Brett, there can still be a benefit in fixing a part of your loan if you want to take out a bit of insurance against potential rate increases. Is that correct?
Definitely. Yeah, absolutely. So there's going to be very, very few scenarios where you incur a cost of splitting the loan and fixing different parts of it. It can be very good for security. It can also be good if you're looking at a term longer than 2 years. So a lot of people might acquire a property with the expectation they're going to have it for 7, 8, 9, 10 years. And maybe looking at 2 years is a little bit short-sighted there. So the 4 and 5 year fixed rates might be of more interest. And that's where you get to the point where the economic forecast is probably not so useful because it's too uncertain over that period of time. So definitely, yeah, splitting it absolutely is an option. So this is probably the more interesting one for everyone out there. So this is not just for people coming off fixed rates, but for anyone with a loan at the moment today. How do I know if the bank's going to give me a good rate without actually chatting to 20 different banks and finding out what they all say? Here's a guide for you, okay? So just look at the first column there, principal and interest. If it's an own off, call it 5.25%. If it's an investment, about 5.5%. So just one thing to note, one important note there is that these aren't the absolute lowest interest rates out there. So we're processing a couple of loans at the moment. We've got one in there for 5.14 and one for 5.17. So lower rates do exist out there, but they're more kind of your basic home loans, no offsets, that kind of thing. Those 2 rates that I put there are a really good guide, broad guide for kind of any bank out there for a principal and interest offset loan. That's what you should be looking at. If you're roughly there, don't feel too aggrieved. If you're on 5.3, It might be that the bank has given you the best rate, they're just not the cheapest bank. If you're on 5.7, it's time to have a conversation with them.
And those rates are after discounts that you were talking about before?
Yep. Okay. Yeah, so those discounts vary quite a bit. Some banks don't have this discount thing. They'll just have a rate that applies for everyone, and that's what you'll see online. So to give a bit of context there, if you went on ING's website right now, you'd probably see 5.24 advertised, maybe say between 5.24 and 5.34. To compare that to Bank of Melbourne would give you about that rate as well, maybe say 5.3. The Bank of Melbourne's website is going to read 6 or 7% because of that discount.
Okay.
Right. Now, the effect of these rates. So again, this applies for everyone. If you're coming off a fixed rate, this is going to happen all in one day for you. You're going to go from 2% to 5.5%. This is all going to happen in one day. But for everyone else, if you haven't reviewed your loan in the last 18 months, this is happening to you anyway. It's just happened in stages. So we've had an increase of 3.5% to our rates since they started going up in March 2022. That equals, for every $500,000 that you've got, that's 17,500 per annum. And if that's for an owner-occupied property, that's about 27 grand of pre-tax income. So if you were earning 80 grand in March 2022, you have to be earning 107,000 per year today to be breaking even. Okay, so it's really pronounced. It's a huge hit. It's the decrease to people's to the income that we've all got to live off is really changed because of this. So what that means as well is that can impact your ability to refinance. So the way the banks calculate refinancing is they take the actual interest rate that you're getting and they add a 3% margin on top. So in March 2022, if you wanted to borrow some money, you were being assessed at a rate of about 5.5%, regardless of the interest rate that they're actually giving you. Whereas today you're being assessed at about 8.5%. So people that borrowed money 2 years ago that now want to refinance because their bank is not the cheapest are being knocked back. We're seeing that pretty regularly. And in some cases, we might be able to mitigate it by structuring it differently. We've worked with our accounting team for a lot of clients to do exactly that. In some cases, the difference might just be too extreme and we can't do it. So we only know that by chatting. And actually, another important note there is that banks calculate things differently. So a good example is that some banks might shade rental income down to 90%. And some might shade it down to 75%. And so the exact same application at two different banks comes with quite a different level of maximum borrowing. And again, how do you know that? You have to chat to every bank to find out. That's what we're for. Chatting to one individual bank, they're not going to tell you, hey, you should go down the road to CBA because their assessment's more favourable.
Yeah. So basically that's the servicing that's considered there, Brett. Is that correct?
Yeah, that's the servicing. Exactly right. So what can we do about that? I mean, your income is your income. As much as we'd all love to have full control over that, we don't. We can change aspects of the loan though. So if you look at the table I've got in the bottom left there, that first scenario, we've got a loan of $500,000 with 150,000 in offset. So for those of us that are lucky to have a bit of an offset balance, we've got a bit of a lever we can pull here. So despite the 150 that's in the offset, the monthly repayment is solely calculated on the loan balance of $500,000. There is a favourable equation that's going on there because the interest that's being charged is reduced. And so the extra that's coming into your loan from that monthly repayment is still paying the loan down. You've got it there in redraw, so there is a benefit there. But for those that are more worried about cash flow, you still have to make that $2,700 a month repayment. If we were to take 100,000 of that and take it off the loan balance and just leave the 50 in the offset, the monthly repayment could be reduced to 2,200, so 500 a month. There's no change in cost for you there. You've still got the exact same net balance being charged interest on, which is 350,000. It's just that cash flow equation has become a little bit more favourable. Well, a lot more favourable, $500 a month. So that's the first lever. That lever can be pulled regardless of whether you change your loan. As long as it's a variable rate, you can transfer money over into the loan account now, today, call up the bank, and they'll reassess your, well, most banks will do it immediately on the spot, and your next month loan repayment will be lower. The cost of doing that is that redraw, that 100,000 that you put into the loan will not be available as redraw. The other lever that we've got to pull, and this one is very different for everyone, it's the resetting the loan term. So on the right-hand side, I've got this example here where we've got $500,000 loan that's already 5 years into its term. Okay, so we owe $500,000 today. We've got 25 years left to pay the loan. The minimum repayment on that is, let's call it $3,000 a month. So if we were to refinance the loan somewhere else onto 30 years again, the exact same loan balance at the exact same interest rate, the loan minimum repayment becomes about $27.60 per month. So it's an improvement of what, $240 per month. Now, this may incur a cost depending on what happens with that difference of $250 per month. So if every single month that $250 that you've saved goes into your offset account, you haven't paid a cent extra for that. It's purely, you know, they net out in terms of interest charges, so it doesn't matter. If what it does do though is, it, number one, it gives you the comfort of having that extra money in your account every month just in case you need it. So you might, for 5 months of the year, you might put that $240 into the offset account and keep saving it, and then in the 6th month, you need to service your car, you need to pay the kids' school fees, you need to fall upon some of that money, you've got the option there. Even if you don't do it, you've had the comfort of having that option the whole time, and you haven't paid extra because you've kept the money in the offset account. If, and some of us are this way, if that 240 was going to go on, you know, some discretionary spending every month, maybe that's not the best option for you. The degree of the change there is determined by the loan term change as well. So if you're 2 or 3 years into your loan term, the difference is going to be quite low. If you're 7 or 8 or 9 years in, you're going to have a really big benefit from that.
So everybody's circumstances are different in that context, Brett, but yeah, so what it does, it provides some immediate cash flow relief, but it means that you are pushing the loan out over a longer period. Is that correct?
You're pushing it out over a longer period if you're only making the minimum repayment, yes.
Yeah.
If you have the money in the offset, because the interest is being reduced, those two things will cancel out.
And it gives you access to the money. Yeah,
it gives you the option of accessing the money. The other thing to keep in mind too is what the repayment strategy of the debt is. So very few people I speak to, their strategy is to repay a loan over 30 years. Generally, the strategy is that they're looking to hold the property for a certain amount of time and then sell it, and that's the primary debt repayment strategy. In that case, again, we look at what the difference is going to be with that money. What are you going to do with the difference? You know, if you want that difference to pay your kids' school fees, well, I would say that's probably a pretty good reason to make this change. If you're going to spend it on Tigers membership, then maybe not so much.
A great investment.
So this is an example that we employed for a client recently. So this client had a bit of a property portfolio that we split. And I'll go through and explain why. This isn't only relevant for people that have a property portfolio like this. It's also relevant for people to just demonstrate the difference of types of loans and types of lenders. Okay, so ignore the actual rates because this was from a few months ago. So interest rates have changed by then, but if we just look at the difference in rates, so the client was with NAB, we had a primary residence loan on 5.15%, and keeping the exact same loan, no major changes to it at all, the rate went to 4.49%, so 4.5%. So it's a huge saving. The thing is that ING wasn't the best for the others though. ING weren't the best for investment lending, and they didn't do trust lending, or they do trust lending, but not favorably. And they also wouldn't take SMSF lending at all. So we looked elsewhere for those loans. So Bank of Melbourne and ANZ were favourable for the investment properties. And an important thing to note there was the refinance cash. So a lot of banks out there at the moment are paying cash for refinances, and they all have different rules around it. So some might just pay $2,000. Some might pay $4,000, but the loan has to be a minimum amount. Some might pay ME Bank will pay you $2,000 if your LVR is 80%, but $4,000 if your LVR is 60%. So there's all these kind of nuances to it, which would determine which is the best to go to. So in this example, so we used ANZ and Bank of Melbourne to get the cash back twice, even though the rates were slightly different. The rate difference of 5 points wasn't enough to undo the second payment of $4,000 for this client. So we went to 2 different banks. Using this same example, if that rate difference was 25 points, maybe it wouldn't have been. Maybe we would have put them both in the same bucket for that reason. And then again, if we look at the SMSF loans, quite a big difference there. So we're looking at 8.16% on 2 loans, one of them commercial, one of them residential, that we got basically 2% off by taking them to 2 different banks. And the reason we did that is First Mac was a cheaper bank. They had 6.04 for SMSF loans, but they would only do residential properties. So we took the residential property there. We went to Liberty for the commercial property because Liberty would take both. They're a little bit higher at 6.29%. So again, the value here is that we deal with all this stuff. We know exactly where these nuances exist and what to look for. You don't need to go and talk to 15 different banks to try to ask this question, and then still don't know if you need to speak to a 16th bank or not.
So, Brett, over your journey, there wouldn't have always been the opportunity for the benefit of these refinance cash arrangements. Is that fair? They sort of pop up every now and then?
Well, yeah, and they pop up. So there's lower turnover in the housing market at the moment. So that means there's fewer new applications coming in for new loans, for purchase loans, which means, and it also means people aren't selling. So the banks might not necessarily have fewer loans on their book because loans are not being repaid back. But the thing is that obviously, as all corporations do, the banks need growth. They look at where they can grow, so they go after refinances. And I've seen probably over the past 7 or 8 years, the cash that they would pay has gone from about $1,000 or $1,250 per transaction up to now. I mean, I've put 4 there. We can get 5,000 and 6,000 for certain high value loans as well for refinances. So the amount of cash has increased dramatically, and there's you're not stuck there. You know, you're not being locked in for 5 years into bad deals. The banks that are paying this money are still giving good interest rates as well.
And these days with technology, it's relatively easy to change banks compared to the old days of paperwork coming out your ears. Is that fair?
Yeah, definitely. Yeah, well, that'll play into my next slide as well. Everyone's different here, but I think if you've got a phone, you're happy to use an app. You know, you've got instant bank transfers, same day bank transfers. There's no reason why you can't have your home loan at a cheap online lender and then have your credit card with a big 4 bank that has really strong, robust, kind of fraud detection, security measures, and that kind of thing, which is exactly what I recommend for my clients. So some of the factors that we would consider when looking to shift. The first one's the interest rate. So this is one that's very evident at the moment now. So we've seen this with one of our financiers, Bank of Melbourne, which we were leading on quite heavily because they had really good rates, good campaign offerings, and processed things really nice and quickly. Then what's happened is they've come out with this campaign. They've had a huge influx of volume, and now they're taking 5 and 6 weeks to process loans, causing our clients to be pretty unsatisfied with the process. And also for us, we don't want to start a process in February when their rates are really good and have it drawn in April when their rates are no good anymore. So, are the interest rates that they offer, is a low interest rate integral to their business? Have they structured their business in a way that they charge low interest rates? So ING, Macquarie, good examples here, online only, try to minimize overheads. If we get a big 4 bank, Westpac at the moment has an introductory rate of 5.14%. That's a great rate for 2 years. It's not going to be there after that because it's just not tenable for their business. Bank policies as well. So particularly for the self-employed clients out there, this is a really important one. Bank policies have changed in response to COVID, not necessarily favorably. So obviously, businesses were forced to shut down. Doesn't reflect poorly on management, doesn't reflect poorly on the customer base that you've got, doesn't reflect poorly on the prices that you're getting for your product, but it is still reflected in your financials. So the banks, basically all of them, just completely stripped out any kind of government payments for COVID. Even when we could show that they were just kind of bringing you back to the same zero position that you were at before COVID, they were still just stripped out. But what the banks did then, not all of them, but some of them have come out and said, we'll assess just get your latest year's financials done, get your FY22s done, we'll assess just based on those, as long as we can show that that was kind of, a sensible figure to lend on pre-COVID as well. So they're all a little bit different there, but that's a really important thing to know. I've also had clients so I noted in the cost option, the 4th point down there, taking a more expensive option now to allow me to move a cheaper one later on. So I've had clients that had a business that was really good, had good trading figures today, but that's not reflected in the financials. So how do we borrow against this when we know that the business is structurally sound, but we just don't have the paperwork to give to the bank? So we have all doc options where we would go with an accountant's declaration to attest that the income is what the client says it is. There's an interest rate premium for doing that, so it might be 1.25%, 1.3%, but it means that you get the property now. So you don't risk missing out while you don't. Yeah, and also, you know, if it takes you 6 or 12 months to get your financials in order, what's the property market going to look like at that time? We don't know. So this is a lever we can pull on to obtain a property now. Worry about the financials after we've settled on the property. Maybe that's 6 or 12 months down the line, and then we can once we've got that trading figures reflected in our financials, we can refinance to a more suitable bank later on.
It's a great strategy actually, because everybody's journey is different. But sometimes you have great years, sometimes your just past year is not so good. But you'd hate to miss an opportunity like this. So that's excellent.
Yeah, absolutely agree. Yeah. And then there's that last point down there, which you mentioned, Ty, before. You know, do we look at using multiple banks? I'm certainly pretty bullish on this idea. Like I said, I'm mostly in favor of using an online bank, somewhere cheap, somewhere you can take your home loan, have an offset account there to dump your surplus cash in, and then keep your day-to-day banks with a Big Four bank that has a big branch network. Like I said, you know, really strong support network, call centers, fraud detection, security detection, all those good things. So there's many factors to consider there. We build all of that into any recommendation that we would give to someone. And that's just about it for me. I'm not sure if any questions came through, Ty, or I've prompted you to ask anything else.
No, nothing yet. But obviously, if anybody does have a question, please pop it up now, and we can run through it. Yeah. So just while I've got you, Brett, just in the event any questions pop up, one of the things that we've often done over the journey is many clients have trusts and companies, etc., that have been funded by the proprietors of the business over the journey, and some of those balances are quite significant. So with Brett's assistance, we've been able to refinance that equity that the stakeholder has put into the business over the journey and pay out what would otherwise be a non-deductible debt in that person's name. So, for example, I go to buy my house, I take out a home loan for it because I don't have the cash to pay it fully because it's buried in my business. With Brett's assistance, we've been able to transfer that debt into the entity, and it takes it from a non-deductible debt into a deductible debt, which can be from an after-tax perspective, a whole lot cheaper than the current situation.
Yeah, absolutely. Any scenario like that. I mean, as I mentioned before, I'm here as a tool for the clients of our firm to use. So I welcome any kind of queries like that, whether it be through your accountant or direct to myself, and we can chat through it for sure.